If you are currently browsing real estate listings and planning to buy property in Florida, I need you to stop what you are doing. Do not sign a single contract, and do not send a single dollar of earnest money until you hear this report. The mainstream media loves to broadcast pictures of a booming housing paradise filled with endless sunshine and zero income taxes. They want you to believe that moving your wealth to the Sunshine State is the ultimate financial shortcut to the American dream. But behind the polished corporate brochures and shiny builder flags, a brutal economic trap has just snapped shut. In 2026, thousands of excited out-of-state buyers are walking straight into a hidden financial crisis that destroys their life savings within the very first year. Your dream home is no longer acting as a secure foundation for your retirement layout. It is gearing up to operate as a permanent, draining liability. And this is where things get ugly. Imagine relocating your entire family from New York or the Midwest to a beautiful single-family home near Orlando or Cape Coral. You calculated your budget perfectly based on the sales price, assuming the low-tax environment would save you thousands every single month. But the moment the transaction concludes, the actual system delivers a massive financial shock to your front door. Internal housing metrics show that over 45% of new out-of-state buyers are stunned by carrying costs that double their expected monthly overhead. The local real estate agents always gloss over these continuous fees during the initial property tours to keep the transaction moving forward. But on the ground, the families who just moved in are realizing that the cost of holding the asset is erasing their liquid cash reserves. Of course, wealthy buyers who possess massive global stock portfolios are not concerned with these unexpected operational increases. But for the traditional middle-class household dependent on a structured retirement check, the failure to verify these hidden numbers results in immediate distress. Many hopeful consumers assume that once their credit score is verified and their down payment is ready, the hard part is over. But in today's chaotic market, new buyers are hitting a massive regulatory wall on the exact day of their scheduled closing. The global banking syndicates will never release the capital for a standard 30-year loan without active, continuous hazard protection. But as the private insurance giants quietly cancel coverage and exit entire zip codes, finding a carrier has become almost impossible. Brokers are watching transactions collapse at the final hour because the structure sits inside a blacklisted zone. The corporate headlines claim the regional economy is expanding rapidly, with endless investment pouring into new subdivisions. But the ground-level reality is a severe financing freeze that leaves ordinary buyers stranded with non-refundable deposits. Would you be willing to risk tens of thousands of dollars in legal escrow money on a property that might become unfinanceable before you receive the keys? Naturally, lenders must enforce these strict guidelines to prevent widespread defaults inside high-risk coastal sectors. But this defensive tightening is turning the purchase process into a terrifying gamble for independent families. When new buyers realize that the traditional private insurance market has completely abandoned their dream neighborhood, they turn to the state fund. Citizens Property Insurance, the state-run option of last resort. They assume that because the government operates the program, their premium rates will remain stable and protected. But in 2026, this public safety net is completely overwhelmed by more than 1,400,000 active policies. The administrative rules have shifted, turning this temporary shelter into a highly restrictive cost trap. Under new mandates, the state can force you off the public plan if a private firm offers a rate within 20% of your current premium. The politicians release optimistic statements claiming these adjustments are necessary to stabilize the public ledger and encourage market competition. But the practical consequence is that new owners are forced into expensive policies managed by small, undercapitalized private entities. Is it reasonable for an administrative system to deny you long-term protection after you invested your life savings into their state? To be fair, the state treasury is continuously looking for macro capital infusions to keep the public fund from facing insolvency. However, the massive concentration of exposure means new buyers are stepping onto a fragile foundation before the storm season even arrives. This brings us to the most deceptive financial mechanism waiting for unsuspecting buyers in the current market: the property tax reset. When you view a listing on Zillow or Redfin, The site displays the historical property tax paid by the current owner. Many buyers assume that bill will remain identical, but the law requires a complete reassessment the moment the title transfers to a new name. If the previous owner held the property for 20 years under protective assessment caps, their tax baseline was artificially low. The moment you purchase the home, the county resets the valuation to match the peak bubble price you just paid. Suddenly, your annual tax bill shoots upward by 200 to 300%, adding hundreds of dollars to your monthly payment. The travel brochures always scream about the state having no personal income tax to lure out-of-state wealth into the region. But the cold reality is that the local municipalities simply extract that revenue through aggressive property assessments instead. How long could your family savings survive if your escrow account suddenly demanded an extra $5,000 to cover a tax shortfall? Granted, individual buyers who relocate to specialized agricultural zones can qualify for unique exemptions that suppress these increases. Yet, inside the traditional master plan subdivisions, this reset trap is destroying the budget of independent households. Many retired citizens believe they can bypass this entire crisis by downsizing into a beautiful condo tower in Tampa or Fort Lauderdale. They think that by avoiding a traditional yard and roof, the community association will absorb the economic pressure. Instead, they walk directly into an automated avalanche of secondary fees. Under intense structural safety laws passed recently, building boards are hitting a legal wall across the entire coast. Private commercial insurance firms are refusing to sign master policies unless these high-density towers fund massive cash reserves immediately. To avoid extreme state fines, the boards are sending out unpredicted invoices called special assessments directly to the individual unit owners. Seniors living on a structured Social Security pension are opening their mail to find emergency bills demanding $40,000 due in full. The sales presentation promised a maintenance-free lifestyle surrounded by luxury amenities and security. But the reality is an absolute cash drain that forces vulnerable residents to liquidate their retirement cushions just to keep their keys. What would you do if your building association delivered a 90-day ultimatum to hand over $40,000 or face the immediate loss of your property? Of course, modern luxury complexes built within the last 3 years feature advanced engineering that keeps baseline operational costs stable. But for the traditional brick and frame buildings that house the true middle class, this fee explosion operates as a financial death sentence. When an independent family realizes they made a massive mistake buying into this hyper-inflated market, they immediately try to execute a retreat. They clean up the property, contact a local broker, and list the home back on the open market. But this is the exact moment they experience the terrifying reality of the exit lock-in. The market has become highly educated. The very first document a smart buyer demands is the actual carrying cost sheet. The moment a potential consumer sees the combination of the reset tax, the HOA fees, and the citizen's premium, they walk away. Even if you locate an out-of-state buyer willing to take the gamble, their traditional lender will deny the mortgage application. The entire transaction freezes because the asset cannot secure affordable hazard protection to back the loan. The traditional real estate narrative claimed that coastal land was a guaranteed wealth generator because they aren't making any more of it. But a residential property that cannot be efficiently financed or protected has a real-world transactional value of 0 to a working family. If a home was blocked from traditional bank financing, would you take the risk of purchasing it using your own hard-earned cash? Obviously, massive corporate landlords and private equity sharks are happy to buy these frozen structures for cheap using institutional cash. But for a regular family whose entire net worth is tied up in home equity, this transactional freeze is an absolute wipeout of everything they built. If you are watching this investigation from a quiet neighborhood in Texas, California, or the Midwest, do not make the mistake of looking away. This is not a localized Florida story. This is the structural blueprint for an unaffordable America. The identical risk matrices and corporate financial tools are being deployed inside your home states right now. The private insurance syndicates are rewriting the terms of property ownership from coast to coast, turning homes into elite commodities. The government agencies continue to publish optimistic statements, claiming the national financial system remains perfectly resilient. But the data on the ground proves that the core foundation of middle-class wealth is fracturing under the weight of hidden costs. Take a hard look at your own property renewals, escrow balances, and local tax assessments this quarter. Are you starting to notice the early indicators of this economic squeeze appearing inside your own zip code? Share your local numbers and your personal experiences in the comments section below, so we can track how fast this system is expanding across the nation. The United States has historically adjusted to structural shocks, and new legislative boundaries may eventually step in to protect the consumers. But before those macro protections arrive at your front door, independent homeowners must see the reality of the trap clearly. Subscribe to remain informed, protect your wealth, and we will see you in the next report.